Welcome to the deep dive. Today we're looking for income, but not just any income. We're hunting for high yield income. And we're doing it in, well, one of the trickiest places, the energy sector.
Mm-hmm. It's notoriously unpredictable.
Yeah, our sources have us looking at how to navigate this volatility in oil and gas. And the core issue, right, is that oil and gas are commodities.
Exactly. And commodities mean prices can just plummet or spike really fast. Makes planning for reliable income challenging, to say the least.
That's the fundamental problem we're tackling.
Right. And the research points to basically two very different ways you might approach this if you want that high yield.
Okay, what are they?
Well, path one is you go big. You invest in a huge diversified giant, someone like Chevron. The idea is scale and diversification offer some protection.
Hedging your bets, sort of?
Kind of.
Yeah.
Path two is almost the opposite. You ignore the commodity swings as much as possible and focus on the infrastructure side.
Yeah.
Think pipelines, storage, what our sources call the boring option. Enterprise Products Partners in the example there.
Boring, but maybe steady. So our mission today for you is to figure out which model really delivers the most dependable income. Is it the massive integrated company like Chevron with all its moving parts?
Or is it the seemingly simpler fee-based infrastructure player like Enterprise? Does boring actually win for income investors here?
Let's dig into Chevron first. CVX. This is your classic global energy major, fully integrated.
And integrated is key here. It's not just a description, it's their strategy for managing volatility. They're involved in everything. Upstream, that's finding and pumping the oil and gas.
Messy part.
Yeah. Then midstream transport pipelines. And downstream refining crude into gasoline, chemicals, jet fuel, all that stuff.
So how does that help with the price swings?
Well, think about it. If crude oil prices crash, say from $80 down to $40 a barrel.
Ouch.
Yeah, ouch for the upstream part of Chevron's business. Their revenue from selling crude gets hammered. But that cheap crude is now a huge cost saving for their downstream refineries.
Okay. So the part of a company that uses oil suddenly gets much more profitable because its main ingredient is cheap.
Exactly. So the downstream profits can surge and help offset the losses, or at least the pain, in the upstream side. It doesn't make the volatility disappear, but it smooths out the ride. It dampens those really sharp peaks and valleys.
Right. And Chevron uses that relative stability to support, frankly, an incredible dividend record for income folks. We're talking, what, about a 4.4% yield right now?
Which is pretty attractive, yeah.
Yeah.
Way above the S&P 500's average, around 1.2%, and even better than the average energy stock at about 3.2%.
But the really eye-popping number is the dividend streak. 38 years. They've increased their dividend every single year for 38 years.
It's genuinely impressive. I mean, think about all the oil price collapses, recessions, you name it. That streak has survived.
It really is something, but there's always a but, right? What's the catch or the risk from an income perspective?
The risk comes down to how that dividend is sustained. Because even with integration, Chevron's bottom line, its profits, can still swing wildly from quarter to quarter. So looking at something like the dividend payout ratio, it's not always that helpful.
Because earnings could vanish temporarily, but they still pay the dividend.
Right. They might pay it out of cash reserves or even take on debt to keep the payment going.
Right.
So that 38-year streak, it relies less on consistent, overwhelming cash flow covering the dividend every single quarter and more on the commitment of the board of directors.
Okay. So it's a strong commitment, clearly demonstrated over decades.
Absolutely. Very strong.
But it's still ultimately based on the board deciding to keep it going. It's a governance thing, not purely a mathematical certainty based on current cash flow.
Precisely. And boards can change their minds, especially if there's a really severe, prolonged downturn. It's a different kind of risk compared to, say, a utility company with super stable earnings.
That's a perfect transition. If Chevron's safety net is diversification plus board commitment, let's look at the alternative. Enterprise Products Partners, EPD, where the safety seems engineered into the business itself.
Yeah. Moving to the midstream space now, EPD. It's structured differently as a master limited partnership, or MLP, and compared to a global giant like Chevron, our sources literally call it downright boring.
And you said earlier, for income investors, boring can be beautiful.
It really can be. EPD owns and operates a massive network of pipelines, storage tanks, processing plants, terminals, primarily across North America. Think of them as the highway system for energy products.
Okay.
They mostly operate on what's called a toll taker model. They charge fees to move oil, natural gas liquids, refined products through their system. Often these are long-term contracts.
So they're not really betting on the price of oil itself.
Largely, no. They're selling capacity in their pipes and facilities. What matters most to them isn't the price of the barrel, but the volume moving through the system, the demand for energy.
And energy demand tends to be pretty steady, right? Even when the economy slows down, people still need to heat their homes, drive cars.
Exactly. It's much less volatile than the commodity price itself.
Yeah.
And that leads to very consistent, very predictable cash flow generation for EPD.
Okay, that sounds good. But you mentioned it's an MLP, a master limited partnership. That sounds complicated. What does that mean for someone listening who just wants reliable income?
It is a key difference, mostly for taxes.
Yep.
MLPs don't issue the standard 1099 tax form you get from most stocks. Instead, you get what's called a Schedule K-1.
Uh-oh. K1 usually means more paperwork.
It generally does, yes. It can make tax filing more complex, sometimes involving filings in multiple states where the MLP operates. It's an administrative hassle, frankly. That's the trade-off you make for the kind of business model stability we're talking about.
Got it. So a tax headache, potentially, but what about the income credentials themselves? How does EPD stack up on paying its investors?
But impressively, they have 27 consecutive years of distribution increases. Now, that's shorter than Chevron's streak.
Still over a quarter century, though. Not bad.
Not bad at all. But the real story is the safety of that payment. How well is it covered?
Right. What's the buffer like?
The buffer is huge. MLPs talk about distributable cash flow, or DCF. That's basically the cash they generate that's actually available to pay out to unit holders like you. EPD's DCF covers its current distribution payout about 1.7 times over.
Wait, 1.7 times. So they bring in 70% more cash than they actually need to pay their distribution.
That's right. A massive cushion. It means even if cash flows dip significantly, they'd likely still have more than enough to cover the payment without breaking a sweat.
Wow. Okay. That sounds much more like a safety net based on current financials, not just commitment.
It is. And on top of that, they have an investment-grade rated balance sheet. So it's strong finances backing that distribution, quantitatively strong.
Okay, let's put it together then. EPD has this massive cash flow cushion, but its yield is around 7%, right? Compared to Chevron's 4.4%.
Correct. Significantly higher yield from EPD.
But Finance 101 usually tells us higher yield equals higher risk. Yet you seem to be suggesting, and the sources too, that EPD's 7% yield might actually come with less business risk than Chevron's 4.4%. How does that work?
It feels counterintuitive, I know. But you have to look beyond just the yield number to the source of the risk in the underlying business. Chevron's business, despite diversification, is still fundamentally tied to volatile oil and gas prices. That's its main risk.
Okay.
EPD, with its fee-based model, is largely shielded from that direct commodity price risk. Its main risk is related to energy demand and throughput volumes, which are historically much more stable.
Ah, I see. So the type of risk is different. EPD has less exposure to the really wild swings of the commodity itself.
Exactly. So the core idea from the sources is that with EPD, you're potentially getting, quote, more yield for less inherent business risk. The stability of that toll road model is seen as structurally superior for income generation compared to the integrated model that still has to wrestle directly with commodity prices.
Even though Chevron is way bigger and more globally diversified.
Even so, for pure income security, the argument is that EPD's model, backed by that 1.7x cash coverage, offers a more reliable foundation. Chevron's safety relies more on management skill and board commitment to navigate the cycles. EPD's relies more on the simple, ongoing need to move energy around.
That makes sense. But there must be a downside to EPD. Besides the K1 tax form we talked about, what's the main trade-off for that stability and high yield?
It's growth. EPD is not a fast-growing company. It's a mature infrastructure business.
Right. They're not finding the next giant oil field.
No. Their growth comes from gradually increasing the fees on their existing assets, maybe building a new pipeline here or expanding a storage facility there, becoming more efficient. It's steady, but it's slow, incremental.
So if you invest in EPD, you shouldn't expect the unit price to double quickly.
Probably not. For EPD investors, that high distribution yield is likely going to be the vast majority, maybe almost all, of their total return over time. The market tends not to give high valuation multiples to these slower-growing, stable cash flow businesses.
Okay, so the total return picture looks different. With Chevron, you're getting the 4.4% yield, plus you have the potential for the stock price to go up significantly if oil prices rise or they have exploration success. You're playing for income and growth.
Correct. Chevron is aiming for total shareholder return.
Whereas with EPD, you're mostly just collecting that fat 7% yield. The unit price might drift up slowly, but that's not the main reason you own it.
Exactly. It's an income play, first and foremost. The lack of exciting growth potential is only really a drawback if growth is what you're looking for. If your main goal is maximizing reliable income now.
Then maybe slow growth doesn't matter as much. You've achieved your primary objective.
Precisely.
Okay, let's quickly recap the two options for you then.
You've got Chevron, the integrated giant, offers about a 4.4% yield, backed by diversification across the energy chain, and a very strong 38-year commitment from the board to keep raising that dividend, despite inherent commodity volatility.
Relies on that commitment.
Relies on that commitment. Then you have Enterprise Products Partners. The boring midstream MLP offers a much higher 7% yield. That payment is backed by rock-solid cash flows covering it 1.7 times over, and its business model largely avoids direct exposure to commodity price swings.
But comes with slower growth prospects in that K-1 tax form.
Right, trade-offs.
So both are major players, both offer attractive yields, but the nature of the income stream and the risks attached are quite different. Which brings us to the final thought for you, the listener.
If EPD gives you that higher yield and arguably more quantifiable stability, but at the cost of growth and tax simplicity.
How should you, as an income-focused investor, weigh that certainty? Is the predictability of those infrastructure fees tied to steady demand more valuable than relying on Chevron's board commitment and diversification strategy, which still leaves you exposed to that underlying commodity risk?
It really comes down to your personal risk tolerance.
Yeah. What level of business risk are you truly willing to accept to get the maximum income today? Is the safety margin of that energy toll road operator worth giving up the potential for higher capital gains down the road? Something to think about.